Friends, welcome to the session. So in this session we will discuss about the different monetary policy tools. So let us start. So this is the lesson number 5 of the monetary policy. So in this session we will discuss about the quantitative tools, which include market stabilization scheme, standing deposit facility, and then we will discuss about different qualitative tools like credit rationing, margin requirements, moral suasion, direct controls, consumer credit regulation, guidelines, etc. Right? So to start with, market stabilization scheme. Right? So market stabilization scheme, the name itself says that it has something to do with stabilizing. Right? So there is some fluctuation in the market. Because of some fluctuation, we need this scheme. So let us see what is the actual condition. So this box, it represents Indian economy, right? Now what happens? Suddenly lot of foreign exchange reserve starts coming to India in the form of investment. So a lot of foreign direct investment starts coming into India, and this is coming in the form of US dollars, right? So a lot of dollars are coming. When a lot of dollars are coming, then the exchange rate between the Indian rupee and the US dollar, that becomes unstable. That becomes unstable, which has an adverse impact on the value of the exports. So when there is too much foreign currency in the Indian market, the impact is the value of the rupee starts appreciating, and that has an adverse impact upon the exports. Our exports become expensive, right? So how this scheme works, how the rupee becomes more valuable, so all that thing we will be discussing when we discuss the chapter of external sector. So there we will discuss rupee appreciation, rupee depreciation. So in detail we will discuss this concept in that chapter. As of now, you just understand that because there is a lot of foreign exchange coming, so the value is actually not stable. To stabilize the value of the India's exchange rate, RBI starts buying these US dollars, right? So RBI starts bringing the US dollar back from the Indian economy, and in return RBI sends the rupee, right? So RBI will buy the dollar, and in return RBI will give the Indian rupee, right? When Indian rupee is being given by the RBI, now in the Indian economy we can see more Indian rupees coming, right? When more Indian rupees coming, that means the money supply starts increasing, right? When money supply starts increasing, this is not a good situation. This is undesirable because it can lead to the inflation, it can lead to other undesirable consequences, right? So this money supply is increasing, this becomes a concern. Now what RBI does, RBI has some government securities with itself, right? So RBI will sell the government security and bring this rupees back, right? So this rupee will start coming back now. But the problem is that this FDI is so huge. This FDI is so huge that the corresponding rupee supply is also very huge, and these government securities, they are inadequate. They are inadequate to buy back all these rupees from the market. Are you getting the point? So these government securities which are lying with the Reserve Bank of India, they are not sufficient to bring back the rupee from the market. So even if the RBI sells all of its government securities, even then the rupee will be extra in the market, right? So to manage this kind of situation, to manage this fluctuation, to manage this unmanaged situation, a new kind of bond is issued, a new kind of security is issued, which is called market stabilization bond, MSB, or market stabilization scheme, MSS. So RBI issues this special bond on behalf of the government, right? So RBI will issue this bond on behalf of the government and will bring back this extra money to itself, right? The money which is received in exchange of the bond, this money is kept in a separate account, right? So can you see that this money which was lying in the Indian economy, which was increasing the money supply, now that is lying with the Reserve Bank of India in a separate account. So this fluctuation which was caused because of this FDI is actually managed because of this market stabilization scheme bonds. So this is how this scheme works. So can you see, in this scheme the government is selling some security and flushing out the Indian rupee from the market, right? So can we say this is quite similar to the open market operations? Yes, this is very similar. So in the open market operations also, the Reserve Bank of India is selling the government security and flushing out the money. But there is a difference. First of all, this open market operation is a regular tool. It is a regular tool. It is not an emergency tool. And this market stabilization scheme, this is an emergency tool, or it is used only exceptionally. It is not used on regular basis. This is the first difference. The second difference from the open market operation is that the open market operation, in the open market operation, both buying of the government security and selling of the government security happen. So both injection of the liquidity into the market and absorption of liquidity from the market happen. But in case of market stabilization scheme, only and only selling of the government security happen and absorption of the liquidity happen. So there is no buying of the government security, right? So I am not saying that the government will not buy back its market stabilization bonds. Definitely the government will buy, the RBI will buy back its own bonds. But the point that I want to make is that this is primarily a selling of the government security, not the buying of the government security. So this is how market stabilization scheme is different from the open market operations, right? Now in the Indian context, this scheme was launched in 2004. And why? Because in 2003 India was shining. So the then Prime Minister Shri Atal Bihari Vajpayee, he used the slogan of shining India. India was getting a lot of foreign direct investment, right? So because of this huge flow of the FDI into India, this undesired fluctuation happened in the value of Indian rupee. And to manage that, this market stabilization scheme was introduced for the first time. So that was the first time when this market stabilization scheme was used. Second time, this market stabilization scheme was used in 2016. So in 2016, which landmark event happened in Indian economy? So in Indian economy, in 2016, in the month of November, demonetization happened. And because of that demonetization, there was a lot of money which was deposited. Lot of money was deposited by the customers, right? And because of this huge deposit, the bank were having huge money with them. So lot of money was deposited into the bank, and because of this excess money, the bank were actually worried. So initially what RBI did, initially RBI said that all the money that is deposited in a specific time window starting from the 8th of November till a particular date, that amount will be treated as the cash reserve ratio. So RBI declared that all the money which is received because of demonetization, that will be treated as the cash reserve ratio. But the problem arose that in the CRR, there is no interest given by the RBI to the bank. So all the money which banks are receiving and giving to the RBI, the banks are not getting any interest. However, they have to pay the interest to the customer, right? Because once the customer deposits into the bank account, in the saving bank account, the deposit rate has to be given. But banks are not getting the return from the RBI. So to avoid this injustice which was happening to the banks, the RBI issued market stabilization bonds, and all the cash was absorbed by the RBI by selling the market stabilization bond to the bank. So bank purchased the market stabilization bond and gave the extra money to the RBI. And on these market stabilization bonds, the banks started receiving the interest income. So this is how this market stabilization bond was used in 2016 also, right? So in two type of situation, one during the excess flow of the FDI, and two during the demonetization, this market stabilization bond is issued, right? So this is the mechanism. Now I am going to discuss the logical side to the exercise, right? So till now we have studied a lot of things about the money flow, etc. So the same thing which I just discussed about the excess FDI, let me show you from another angle. So now we are going to see another angle to the same transaction that we just discussed in the previous slide, right? So this is the RBI balance sheet, right? These are the assets and these are the liabilities. On the asset side, we have foreign currency and we have government security and so on, right? On the liability side, we have high powered money in the form of notes, in the form of coins, right? So we have already seen this liability, this RBI balance sheet when we started the discussion of the money. So there is no doubt about this balance sheet. I am sure that you remember this balance sheet, right? Now, how the transaction happens, let me show you. So how the transaction happens, when FDI starts coming, that means this foreign currency starts increasing. The volume of the foreign currency starts increasing, right? Now, this is a balance sheet. In the balance sheet, both the sides, the asset side total and the liabilities side total, both have to match. If on the asset side the total is 100 rupees, on the liability side also it will be 100 rupees. So if on the asset side, because of extra foreign currency, the total becomes 110, on the liability side also this total has to be 110. That means correspondingly this high powered money will also have to be increased, right? So this high powered money has to be increased correspondingly. If high powered money is increased, that means because of the money multiplier effect, this money supply also increases, right? So because of the money multiplier effect, this money supply also increases. So can you see the impact of FDI is that the money supply is increasing in the Indian economy, right? Now, to avoid this increase in the money supply, what RBI does, RBI sells the government security, so the quantity of the government security is reduced, corresponding to the foreign currency increase, right? So now this is not 110, this is 100 only. So 10 rupees government security is sold in return of the 10 rupees foreign currency increase. So 10 rupees foreign currency increase and 10 rupees foreign government security decrease. So overall the situation remains 100 only. So here also it will be 100 only. That means there will be no extra money supply, right? So can you see that? Yes. Now consider the foreign currency is coming to the extent of 50. More foreign currency is coming, but we don't have the extra government security. We don't have the extra government security. Because we don't have the extra government security, therefore we cannot manage the asset side, and we have to increase the liability side correspondingly. That means the high powered money has to be increased by 50. That means there will be multiplication and money supply will be increasing, right? So can you see, when the government, the RBI is not having sufficient government security, then the money supply will automatically increase in the absence of because of the extra FDI. So to avoid this situation, what RBI does, RBI issues the market stabilization bonds to the extent of 50, right? So it takes the permission from the government, because government is the owner of the government security. RBI is just custodian. So ownership is with the government. So it takes permission from the government and it issues the market stabilization securities, and it takes back this 50 rupees from the market, and it keeps this money in a separate account. So it will be in the liability side only, but in a separate account. So can you see that because this money is now lying in the separate account, therefore this money supply is not increased. So this is another angle how you can view this transaction, right? So did you enjoy this? Yes, right? I know you enjoyed this. You enjoyed how this market stabilization happens in reality, and how this market stabilization scheme is showing up in the balance sheet, right? Now we have discussed the entire concept. I am 100% sure that you will understand each and every aspect of this. Now this is in the language form, so I am giving you 30 seconds to read this slide, and then we will start. So friends, before we move ahead, let me also tell you one more term. That term is called sterlization. So what is sterlization? Sterlization is a situation where the government is issuing the bonds and absorbing the liquidity, right? So when the market stabilization bonds are issued and the liquidity is absorbed from the market, then it is called sterlization of the Indian economy. This is called sterlization of the Indian economy, right? So this is the term which I wanted to tell you, right? So historically, RBI had been sterlizing the effects of significant capital inflows on the domestic liquidity by offloading parts of the stock of government securities held by it, right? So historically, whenever there was excess FDI, the government will use the open market operations mechanism. It is pertinent to recall in this context that the asset side of the RBI balance sheet includes foreign exchange reserves and the government securities. So we have already seen in the last slide, while the liabilities are primarily in the form of high-powered money consisting of currency with the public and reserves held in the RBI by the banking system, right? So on the asset side we have the foreign currency and the government security. On the liability side we have the high-powered money. Thus, any rise in the foreign exchange reserve, so any rise in the asset side entails a corresponding rise in the high-powered money, right? So any rise in the asset side means the liability side will automatically rise. The money supply in the economy is linked to the high-powered money. Therefore, on the face of large capital inflows, to keep the liability side constant so as not to raise the supply of money, corresponding reduction in the stock of government securities by the RBI is necessary. Now read this, take 30 seconds and then I will discuss this. So the MSS, Market Stabilization Scheme, was devised since continuous resort to sterilization. So this term sterilization has been used. What is the meaning of sterilization? Sterilization means RBI issues the government security and absorbs the liquidity. Since continuous resort to sterilization by the RBI depleted its limited stock of government securities and impaired the scope for the similar interventions in the future. Under this scheme, so under the MSS, Government of India borrows from the RBI, such borrowing being the additional to its normal borrowing requirements, and issues treasury bills or dated securities. So treasury bills or dated security means the government security that are utilized for absorbing excess liquidity from the market. Therefore, the MSS constitutes an arrangement aiding in liquidity absorption, right, in keeping with the overall monetary policy instance of the RBI, alongside tools like the liquidity adjustment facility and the open market operations. So the regular tools are already being used. The liquidity adjustment facility and the open market operations, these tools are already being used. It is not that we are not utilizing those tools. The selling of the government securities depleted the limited stock of the securities held by the RBI. Therefore, MSS came in the 2004, right? Now read this, take 30 seconds and then I will discuss. So, the MSS was launched in April 2004. During 2002 to 2004, there were huge capital inflows into India. This led to the appreciation of the rupee, and this made the exports more expensive. Therefore, RBI started buying US dollars and it increased the liquidity. To combat this, RBI sold government securities to withdraw the excess liquidity. This withdrawal of excess liquidity is known as the sterilization. So there can be a question in the examination, what is sterilization? So withdrawal of the excess liquidity is called sterilization. How market stabilization scheme is different from the open market operations? So I already told you there are two aspects. One, that market stabilization scheme is used in the emergency, and open market operation is a regular activity. Market stabilization scheme, here only selling is done, and in the open market operation both selling and buying is done, right? Selling and buying of the government security is done. So here you can read the language. Take 30 seconds and read this. Okay, so the first three paragraph I already discussed. The last paragraph says, however, following the global financial crisis of 2008, so in 2008, India faced impact of the global financial crisis. So at that time, the government required a lot of money for doing the expenditure to revive the economy, right? So at that time, government converted a portion of MSS funds into the normal government borrowings for financing its stimulus expenditure requirements, right? So normally the MSS money is kept as separately. However, in 2008, certain percentage of that money was allowed to be used for expenditure. So that was converted into the normal government borrowing from the MSS. So on this part, there was impact on the fiscal deficit, because when the interest is given, then it impacts the fiscal deficit. Otherwise also, the interest is given on the market stabilization scheme, that is going from the fiscal deficit only, right? That is going from the treasury of the central government only. So that has an adverse impact upon the fiscal deficit. Now you can see what are MSS bonds. So MSS means market stabilization scheme. These are the special bonds floated on behalf of the government by the RBI for the specific purpose of mopping up excess liquidity, right? And these are purchased by whom? These are purchased by the institutions like banks. Now, during the demonetization, I already told you, there was sudden surge in the deposit which disrupted the functioning. So RBI said that all the extra money that should be treated as the CRR. However, CRR do not fetch any kind of return from the bank to the bank. Therefore, these MSS bonds were allowed. The good thing with the MSS bond is that they earn a return, that is they provide the interest income to the bank, and they qualify for the SLR. So if the bank is buying these MSS bonds, then it can be counted in the SLR requirement. So the SLR compliance is also done, and they are also tradable in the secondary market, unlike the CRR. So how MSS bond is different from the CRR? This is the difference. If there is a question, then you can answer. So this image I have taken from the newspaper of 2017. In 2017, this MSS limit was increased to 6 lakh crore. So the RBI was allowed to issue the bonds up to 6 lakh crore for a period of 28 days, right? So earlier this limit was 30,000 crore. Now it was allowed to be increased to 6 lakh crore for a period of 28 days. Here you can see the prevailing rates of all the important indicators. So we have cash reserve ratio, statutory liquidity ratio. If we combine both of them, this is called variable reserve ratio, and we have the policy rate, which is the repo rate. So you can see this reverse repo rate is 0.25% is less and this is 0.25% extra. So how much is the corridor? Corridor is 0.25%, right? This marginal standing facility and the bank rate, they are equal. So they are above the repo rate and they are equal also. Now next, standing deposit facility. Standing deposit facility. So what is this? So this is also one of the new tool introduced, right? And before I discuss this tool, let me tell you that quantitative tools that we have discussed, we can divide these tools into two major categories. One is conventional and another is non-conventional. So what is the difference? The conventional tools means which have been used for long time, right? Non-conventional means which are being used since the 1991 reforms. So non-conventional quantitative tools means the tools which are being used since 1991. So out of the quantitative tools, which tool fall in this category? So CRR, SLR and bank rate. So these three tools fall in the conventional category. In the non-conventional, liquidity adjustment facility, that means repo rate and reverse repo rate. We have marginal standing facility, that is emergency facility. We have market stabilization scheme, right? So these are the non-conventional tools. Now this SDF, standing deposit facility, this is a proposed facility. This is a proposed facility, right? This is a proposed facility. So this proposed facility is being considered to be implemented, but it has not yet been implemented so far. So now what is this standing deposit facility, right? So we know that in case of repo transaction or in case of reverse repo transaction, one of the important aspect is that there is some collateral. Collateral means some kind of security, some kind of security is kept, right? So this collateral is kept. कुछ ना कुछ हम गिरवी रखते हैं, इसको हम बोलते हैं गिरवी रखना. तो कुछ गवर्नमेंट सिक्योरिटी को हम गिरवी रखते हैं किसी भी ट्रांजेक्शन जो कि रेपो या रिवर्स रेपो के अंदर होता है उसको करने के लिए, राइट? नाउ देयर कैन बी अ सिचुएशन वेयर आरबीआई वांट्स टू suck the money from the market, but it don't have the government security with itself, like that happened in the demonetization. Or otherwise also it is possible that bank wants some money from the RBI and the bank is not having the government security which it can use as a collateral. So this collateral becomes a constraining factor in the efficient liquidity management. Can you see? This collateral becomes a constraint in the efficient management of the liquidity. So this becomes the problem. In the standing deposit facility, we are saying that in certain situation, there will be no need of collateral. There will be no need of collateral. So this is the only difference between the repo or reverse repo and the SDF. So the main thing about the SDF is that there will be no collateral, so that the collateral does not become a constraining factor in the liquidity management. So this is the primary thing that has to be seen. So just read this, take 30 seconds and then we will discuss this. So banks at different points of time they may have shortage of fund, they need money, and if they go by the repo transaction, then they have to place the government securities. Similarly, RBI, if it has to do the reverse repo transaction, then it has to use the collateral as the security. This is the normal condition. This concept was introduced for the first time by the Urjit Patel Committee in 2014, right? And it said that in this facility, there will be no requirement of collateral for liquidity absorption. So, the finance minister proposed this in the budget of 2018-19. In the budget of 2018-19, the finance minister proposed this facility, and it proposed that central bank can come up with an additional instrument for the liquidity management where no collateral will be required. So why this was necessitated? This was necessitated because of the post demonetization, where the collateral became the constraining factor. So in this case, the RBI can absorb the surplus fund and the banks can continue to earn the interest, right? Banks can continue to earn the interest and the RBI can suck out the liquidity as and when required without pledging the security. So this is standing deposit facility. So friends, I am sure that you must have enjoyed all the quantitative tools, and in the examination hall there are 99% one question will be coming from the discussion that I did, right? So I did not restrict the discussion just to the basic. I discussed all the historical evolution, I discussed all the possible implications so that you are confident. Now, coming to the qualitative credit control measures, right? So, we have discussed quantitative tools so far, right? So, in the quantitative tools and in the qualitative tools, what is the difference? How the two are different? Quantitative tool and the qualitative tool, how two are different? So in the quantitative tool, the focus is upon volume. Increase the volume, decrease the volume, suck the liquidity, inject the liquidity, right? Absorb the liquidity, inject the liquidity. So this is the focus in the quantity. In the quality, the focus is upon the use of the credit. Who will be using this credit? Whether the poor person or rich person, industrialist or household. So this credit will be directed to the particular desired sector. So in any economy, we have household, we have firms, we have the government, and we have different weaker section in the society. We have MSME, micro, small and medium enterprises. The purpose of this qualitative credit control measure is that the credit can be provided to the selected sector up to a level, right? So this is how this qualitative tool works. So this is also called as the selective tool, because this is not a general tool. General tool is where the entire economy is impacted, but in the selective tool, only a particular sector is impacted. These tools are not directed towards the quality of credit. They are used for discriminating between different uses of credit. So focus is upon different uses of credit. So there can be a discrimination which can favor the export over the import, or which can favor essential over the non-essential credit supply. It can have an impact over the lender and the borrower over the credit, right? So you can see it can shift focus from import to export or vice versa, from essential to non-essential or vice versa, from lender to borrower and vice versa. So anything can happen by changing the direction. Now there are different tools which are used in the qualitative tools. So these are the tools. Now we will discuss each one of them. So the first tool is credit rationing, right? Credit rationing. So credit means money supply, rationing means allocation, right? So here we are allocating the available money supply in the different sectors of the economy, right? So if there is no control, naturally the bank will like to give loan to the more rich people, because the rich people can return back the money. The bank will never like to give money to the poor people, because the poor people may not have the source of income in the future, and the bank's loan can become NPA. However, in practice, it is a different thing, that nowadays it is the rich person who is doing the most NPA. So Vijay Mallya, Nirav Modi, they are the richest person, still they are making the account NPA. So that is a different story. That is the practical world. But going by the logic, a banker will always think that I should give loan to the person who is having some property, because in future, if the person is not earning, I can sell the property and I can get my money returned back, right? The banker will never think to give loan to the poor. But do you think this is the required, this is the desired situation? No. If we want inclusive growth, if we want that every section of the society should develop, then there should be equal flow to all the sectors of the society. So here this credit rationing comes into play. So normally there is shortage of funds, especially for the priority and the weaker industries. So in the credit rationing, central bank can impose the maximum limit upon the loan that is available to the large industries, or it can ask for charging the higher rate of interest on the bank beyond a limit. So if someone is taking the loan of 1 crore, the bank will charge 10%. If someone is taking the loan of 12 crore, then it will charge maybe 15%. So the big amount loan will be reduced and the amount will be distributed in more number of people into small amount. So this is how the equal or fair distribution of the available money supply can be ensured, right? So this is very, very crucial, credit rationing. Next is change in the lending margins. So what is lending margin? So lending margin, just try to understand. Suppose you go to the bank and you want some loan, right? So you are a student, you don't have any source of income, and you never know when UPSC is going to clear you. So my wishes are with you, but still the bank will not believe you. Bank will not give loan easily to you. So what you will do? You have some property with yourself. Maybe you are having some gold which you got as a gift from your parent. So you give that gold to the bank as the mortgage. उसको गिरवी आपने रख दिया, right? So you give the gold of 1 lakh rupees to the bank. Now you demand from the bank that Mr. Bank, please give me 1 lakh rupees. Do you think bank will give the 1 lakh rupees in return of the gold, this gold? No, because that will become the sale and purchase transaction. The bank will not give 1 lakh rupees. Bank will reduce some amount and give, for example, rupees 80,000. So this difference of 1 lakh, the value of the property that you are putting as a mortgage, and this rupees 80,000, the amount of loan which you are getting from the bank, the difference between the two, that is rupees 20,000, that is called lending margin, right? So now when this lending margin is 20,000 rupees, that means 80,000 rupees is going into the market. When this lending margin becomes 10,000, that means 90,000 is going into the market. And when this becomes 30,000, then that means that 70,000 is going into the market. So change in the margin requirement can impact the money supply. And you might think that, sir, if it is impacting the volume of the money supply, then should it not be included in the quantitative tool? No, it will not be included, because this lending margin can be changed for particular sectors. So sometimes it will be used for the auto sector, sometimes it will be used for the home loan, sometimes it will be used for the education loan. So for different sector, it will be used at different times so that the desired money supply can be maintained in a particular sector. If, for example, if there is huge money supply in the home loan market, then the margin, lending margin will be increased so that less money can be supplied in the home loan market. So that is why this tool remains selective tool. So this is not a general tool, this is not a quantitative tool, this is a qualitative tool. So the gap between the value of the mortgage property, so in our example 1 lakh rupees, and amount advanced is called as the lending margin. Central bank has the authority to determine the lending margin with the view to decrease and increase the bank credit, right? So central bank can actually change the lending margin. The objective is to control speculative activity in the stock market also. That is also there. Now, next tool is moral suasion. So moral suasion, so it has something to do with the psychology. So it is a psychological instrument, right? So here persuasion and convincing is done and direction is given by the central bank. So central bank tries to control the banks, the head of the banks emotionally. Please give loan to the weaker section, please give more loan to the women, please give more loan to the agriculture section, please give more loan to the UPSC student, right? So this moral or emotional direction is given, right? So here central bank can also put the pressure. It is not that central bank is a requesting board. Central bank is authority is always authority, right? So guru to guru hi rahega, right? Baap to baap hi rahega. So central bank uses the moral pressure on the commercial bank by going public on unhealthy banking practices. So if the banks are not following some healthy practice, then it can go and publish in the newspaper and can give the direction, right? Next is direct controls. So where all the methods are becoming ineffective. So all the methods are becoming ineffective, then central bank can give clear direction. It can stop rediscounting. What is rediscounting? We discussed in the bank rate. It can stop repo transaction or reverse repo transaction, right? So this direct action can go to the extent that the operation of the bank can be affected severely. Qualitative tool next is consumer credit regulation, right? So nowadays there are a lot of transactions happening for the consumer durables, right? Consumer durables, for example, we take laptop as an example, right? So laptops, normally there are a lot of installment facilities available from the side of vendors, from the side of banks, right? So if you want to buy a laptop of suppose 1 lakh rupees, you go to the bank and bank says that you can buy the laptop, but you have to pay 15,000 as the down payment from your pocket, and rest 85,000 you can pay in the installment of 5,000 rupees, right? So this is the one situation. Now if RBI wants to impact the money supply in the laptop segment, in the electronic segment, right, then what RBI can do? So if RBI want to increase the money supply, want to encourage buying of the laptop so that more and more students can take the advantage, so RBI will say that you can take the down payment of 5,000 rupees and rest 95,000 you can take the 3,000 rupees installment. So when only 5,000 is the down payment and 3,000 is the installment, then more number of people can buy the laptop because the immediate burden on their pocket is very, very less. So because the immediate burden on their pocket becomes very less, therefore more and more people they can buy the laptop. So this is how this consumer credit happens. So this issues the rules regarding the down payment and the maximum maturities of installment credit for the purchase of goods, right? So one situation is, so here you can see in the when the 5,000 is the installment, then maturity is 17 month. So in the 17 month, the amount has to be returned back. When the installment is 3,000, that means the maturity is more than 30 month, right? So this maximum maturity has been changed from 17 months to the 30 month, right? So change in the down payment and change in the maximum maturity, both are done. Next is guidelines. So RBI can also issue the oral guidelines. So governor goes in a function and he can discuss with the heads of the banks, written statements, appeals, guidelines, and also the warnings. Direct action. So this I have already discussed. So when the banks don't fulfill the condition, then RBI can refuse to honor the discounting, and it can charge the penal rate of interest above the bank rate also, or it can stop the repo and reverse repo rate transactions also, right? Now the question. So just read this question and then we will discuss. So this is the UPSC question of 1995. So in the recent time, no question has come, but there is no guarantee that question will not again come. The question can come from any time. Which one of the following is not an instrument of selective credit control in India? A. Regulation of consumer credit. So this is the tool, therefore this is not the right answer. Rationing of credit, this is also not the right answer. Margin requirement, this is also not the right answer. Variable cost reserve ratios, this is the answer, because this is basically the quantitative tool, right? So answer is option D. Very easy answer, very easy question. So with this, I really want to thank you. I hope you enjoyed the entire quantitative and the qualitative tools. Now in the next session we will discuss about two types of monetary policy, expansionary and the contractionary monetary policy. What are the limitations of the monetary policy? So in the recent times, we hear a lot of times that despite the repo rate coming down, still the interest rate for the normal consumer, it is not coming down. So what is the reason why the monetary transmission is not happening? What is the limitation of the monetary policy? Why we are expecting a situation of stagflation, where the inflation is very high and the demand is not there? So all these things I will be discussing in the next session. So watch the next session. Enjoy that. Thank you very much. God bless you.